You feel confident, you start buying property.
Across the board in Australia, there are certain cities that are obviously more sensitive to this rate cutting cycle.
When interest rates get cut, the return on cash, the money you have in your bank account, starts coming down too.
Why don't I now take my money? I'm a little bit more motivated to go and put my money into something slightly higher risk that's not a term deposit.
Like, what do I do with my money?
It brings confidence back, right? And confidence is key.
Australia's next housing cycle has well and truly begun. The dominant theme of 2025 has been falling interest rates and a complete recycling of which markets in the housing market are doing well across Australia. We've noticed that already. If you look at growth rates, we're past the middle of the year now, and you look at growth rates and you can see a big divergence down from some of the capitals that were dominating over the past few years, and the big rise up from the markets that we've been talking about at length. Melbourne, Sydney, and Darwin have been rising up those rankings very, very quickly. In this episode, we're going to go through 5 reasons why this is happening and what that interest rate story does to housing markets. And this bit's the golden nugget. We're going to go through state by state again, unpack the nature of their economies, and see how it will play out for the rest of the year. This is the high level strategy you need to know to help you work out and stay one step ahead of the game to unpack which markets are going to do well over the period ahead. It is something we've been doing throughout this channel to help you be a little bit ahead of the game before all the others start floating in and around here. The high level economic principles that drive the suburb selection, the property deal making, and what is actually happening. Adi, how are you, my man?
I'm good, man. I'm really excited about this one. I obviously see a lot of this macro level data, especially the interest rate changes, flow through to the property level data, and we're seeing certain pockets. We're sort of at the tail end of the year now. We're sort of seeing certain pockets in Melbourne, especially. I know it's been lower performing in the last few years, and what that has done to the psychology of people. You get a 10% bump up in your borrowing capacity, and suddenly you're turning up at every Saturday inspection.
Boom,
love it. So we are seeing a lot of that demand. We picked up on it. This time last year, we're like, yep, Melbourne is going to be the next mover as affordability increases through interest rate changes. That's what happens, guys. There's a system to this thing. If you know how to work your way through the system, there is a way for you to be ahead of the curve as well, and you don't have to run a buyer's agency with 8 people to be able to pick these things. You can do this yourself.
For sure.
You just have to be a nerd.
Yeah. Buying in the right market does a lot of the work for you. Buying in the right market at the right time does the majority there. Buying the right market at the right time and buying the right asset, that's the trifecta of combination where you're going to do really, really well.
Exactly.
This is what we're going to be unpacking, what the future looks like. So let's go by the reasons why these markets are, the reasons why the interest rate story is driving success to property and these markets in particular, which we'll go through a little bit later. Let's start with reason number 1. What have we got here?
So you've said cash returns are lower in a lower interest rate environment.
Yes. So here, when interest rates get cut, the return on cash, the money you have in your bank account, starts coming down too. It's like going into work every day and then being like, hey, boss man, you're paying me. And then be like, boss man? Boss woman, sorry.
Boss person.
Boss person. You're paying me less money to do what I normally do? That kind of sucks. When that happens to you, what are you going to do? Most people go and be like, hey, can I start moving and start angling my finances around and maybe swap my job? That's what happens with cash rates coming down. It changes behavior. And the behavior change that it triggers is, I want a higher return. So I'm going to move up the sort of risk spectrum of assets. Cash is the lowest risk spectrum, where you just buy something like a term deposit or a government bond or something like that. It's just a very, very simple return. And then you move up the cash, the risk spectrum, because you want a higher yield and a higher return on your investment. This is something that benefits all asset classes, not just property, but property is a big winner from it because property is great alternative, especially for those who hold cash, because it's very, very safe.
So can I just understand this more? So when interest rates come down, obviously the interest that you're earning on the money that's sitting in your account is lower.
Yes.
As a result, you're like, oh, why am I only making 2% now or 3% when I was making 6% a little while back? Why don't I now take my money? I'm a little bit more motivated to go and put my money into something slightly higher risk that's not a term deposit. And that's where property sort of comes in. And obviously there's a leverage component to property, which, interest rates play a pretty big role in that. And suddenly that becomes a lot more attractive. Is that
100%? 100%, yeah. It's the risk-free
I'm an economist now, so I don't know.
Genius, you nailed it. This is like economics 101 unpacked. I think many people in this audience will be like, duh, read them. Like, hello, I know that already, okay? Like, I can imagine there's people thinking that.
They're very sassy, your audience. That's very cool.
I have a 5-year-old at home, so I'm dealing with the sassiness in my beautiful household at the moment. So that was probably that coming out. What's number 2 here?
Number 2, your borrowing capacity is up 5% in 2025 already.
Yep, 5, 7.5, 10% in that range already. Rates coming down. We've had multiple rate cuts already.
Correct.
Borrowing powers go up. When borrowing powers go up, house prices go up in Sydney. That statement isn't necessarily a statement of fact and holds true all the time. There could be other variables, but has held true over the rate cutting cycle since 2017, where we have measured it at Flint Invest, where we've done through the modelling. Every time interest rates get cut, borrowing powers increase, and house prices, in Sydney at least, have increased by pretty much the same corresponding amount at different points since 2017 all the way to 2025. On the cutting cycle, that relationship has held. So more money in your bank, in your back pocket means more money lent to you from banks. More money lent from you by banks means higher property prices. People
just spend more,
borrow more.
Right? Yeah, that's
exactly.
Right. Probably flows in nicely to number 3. History doesn't lie, right? Property prices do increase over time.
Love this one.
Yeah. So tell me about what's happened in the last 40 years.
Have 40 years. 40 years. I am 35 years old now. I've passed my birthday. I'm 35 years old. 40 years. So for the past 35, 40 years, every single time, and we've had over 10 experiences of this, property prices rise nationally in the 2 years afterwards, or in the year afterwards, of rate cuts. You need to put 2 years because some of these periods, rate cutting quite regularly happens when the economy is doing pretty poorly to promote the economy. And sometimes in that, there's a little bit of freaking out, right? But after the freaking out, and people go back and it's like, it's not so bad. That's the normal sort of behavior transmission that happens. Property prices then begin to rise again. So in this time around, interest rates are being cut without the bit. So we don't have that. So it's just straight to the property prices just begin rising quicker and right away rather than after a period of fear.
And we started seeing that in the first half of the year, right? We've been talking about Melbourne, God knows how many episodes we've done now in the first 8-9 months of the year on Melbourne. And some of those movements have been a direct correlation with people have more money than they did, RBA meeting ago, and suddenly they're like, let me pay a little bit more to get into this market. 100%. And a lot of the markets we're buying in are very owner-occupier dominant. A lot of people are upsizing, they've been looking to move, but they've been sort of at a standstill for the past 3 or 4 years, and suddenly they're like, I've got 30 grand more to spend. Exactly. Let me go and do it. So
there's a lot of Melbourneites out there.
There's a lot of Melbourneites.
There's a lot of Australians out there, all in jobs at the moment, doing very, very well for themselves and have some savings, and they're willing to invest, and they've got some spare leftover money. Don't believe what you read and hear all the time. It's not chaos out there.
Except this one, of course. Believe this one, but just not.
I mean, mass media. If you follow the general tune of it, fear sells, negativity sells. So it's not nearly as bad as the media will make it out. In fact, it's pretty good. We got a very low unemployment rate.
We do.
We have positive growth, which pretty mediocre growth levels, but we have the economy growing. We have really low unemployment. We have a lot of population growth that has happened over the past few years. You have pretty strong broad conditions. You have interest rates coming down. You have pretty stable conditions at the moment. And that means that people are out there being like, what do I do with my money? They're investing in property, or they're, deciding to upgrade their home, or, go and purchase a home to live in. That is increasingly the behavior, and the strength of the Australian economy is driving that.
Absolutely, man. I think this goes nicely into number 4, because what the rate cutting cycle does, or has done at least, and we've seen this time and time again, brings confidence back, right? And confidence is key. And we're seeing that sort of happen. So can you walk us through, I guess, what role does sentiment have to play?
In psychological, for sure. Like, you feel confident, you start buying property. Again, this is that story. If you go through the history of time and measure the consumer confidence surveys and the time to buy surveys for property as well. So Westpac, ANZ both have measurements for this over extended run of time. When confidence increases, property demand increases as well. That's pretty normal when you feel pretty good about things and you beat your chest out. Like, I play football every weekend, and when I feel pretty confident, I'm like, yeah, I'll go shoot from the halfway line. I'm going to score. Quickly doesn't happen, but the confidence makes you go and do things and take action. That's what happens. That's the behavior element. And en masse, we measure that confidence, and that confidence starts spilling over with especially this backdrop where interest rates are falling, but the economy is pretty stable and doing pretty well. In that backdrop, it's like, whoa, I'm very confident.
Yeah.
And you're putting more money in my pocket? Hells yeah, I like this. I like this. That's how people feel at the moment.
Yeah, and I think to put a lens of what it feels like for a buyer's agent, in the 17 months of me doing this now, I've had quite literally hundreds of conversations, and so many of them have been, I'll just wait for the interest rates to come down. And those people are back. They're back. Oh my God, they're actually, I was like, this is, maybe.
I noticed that. Right?
They're suddenly back.
Who's this person from 18 months ago who spoke to? Be like,
oh my
it's pretty
gosh,
crazy,
12 months ago you were like freaking out because the interest rates are too high and they're like, it'll never come down.
Yes.
But your trigger was, they literally saw 2 RBA cuts. Or 3 RBA cuts. I don't even know how many we're at the moment.
Yep.
And suddenly that confidence is back. And they're like, yep,
sure.
I'm ready to do this.
For sure. Golden nugget for the audience here. They want to know this. Flint Invest and Flint, the bigger group that I run and manage, that has a lot of mortgage broking divisions all across Australia. Big office in South Australia, Farmers Finance, She Invest up north. Lots of different mortgage businesses. Mortgage land is crazy land at the moment. Crazy land is the best word to describe it. It has never been busier in our time period as a broker. The conversations are strong now. That's the best way to describe it. Lead flow is stronger. Settlements are stronger. Every lead indicator for mortgage demand is going to rise pretty significantly, which tells me that Sydney and Melbourne property prices in particular will have a decent 6-month period that we're having now, and Melbourne for an elongated period. I get asked this a lot, why Sydney or Melbourne? I think Sydney will do very well in 2025 now from this rate cutting cycle, but it won't be an elongated growth cycle. Melbourne will see that growth cycle continue for years because it's got more potential to rise from its affordability frameworks than Sydney. So that confidence is there.
I love it. I think the last one that we wanted to talk about is the domino effect that happens from the RBA's decision making. So walk us through that. I mean, lower interest rates mean you can spend more, you put more into the economy, more jobs, more
it's
everything.
Party time. That's
exactly.
What
That's
happens.
right. Yeah, that's right.
Yeah, that's my party. Do you want to do one?
I would rather not. Thank you.
Okay, cool. Adi's left me hanging. I am. He didn't have the face, but he did have the hand movements. Okay? Right. It's party time. That's the best way to describe this. Yeah. More money in your pocket, lower mortgage bills, lower mortgage expenses means businesses go and invest more. People are consuming more. The retail sector improves. The housing sector will begin to improve. By housing sector, I mean the construction industry will begin to improve. Feasibilities look better for property developers. Construction activity kicks off. You're talking about multiple sectors, probably around 30-ish% of the broader Australian economy, really interest rate sensitive, like retail, construction, a lot of the service industries that we have as a nation. We're a consumption-based economy that is driven by domestic demand, by Australian spending money. That is the composition of the Australian economy. Like China, for example, very, very different. It's not Chinese people spending money. It's Chinese people building things, giving it out to the world. That's that composition of the economy. Australia, obviously, it is a huge, huge mining and energy nation, powerhouse for the world, but it is also a very strong household sector-driven economy, and interest rates are kind of tilting up the dynamics for a huge marketplace. So that promotes economic activity. And that activity then starts filtering through to the housing market. People feel confident, like we've said. Businesses are employing more, but that helps the economy. And when the economy is held, more people have jobs. That job creation then creates even more housing demand as a result.
It does. And I know we've touched on this already, but across the board in Australia, there are certain cities that are obviously more sensitive to this rate cutting cycle. We've touched on two already. Can you just walk us through what you're seeing as an ex-economist about what some of the other cities will see as a result of this rate cutting cycle?
Yeah, let's just go one by one. Start from the top.
Sydney and Melbourne.
Let's go Sydney. I break it down. Sydney going to do really well. Always very, very sensitive to interest rates. The most obvious sensitivity because they have the highest mortgage debt balances. And it's going to perform almost synchronized with interest rates. If interest rates fall, 1.5%, I imagine Sydney house prices will rise 15%.
Wow.
I'm just going to do some math, basically. This is bro math or red math, if that makes sense. It's just concurrent with whatever the price drop of cash rates are. That's how much Sydney house prices will rise by broadly over this 2-year period. That's pretty strong, especially if the economy holds. So that's Sydney.
Beautiful.
What's next? Melbourne. Melbourne's economy is the most interest rate sensitive. As a guide, the retail sector in Melbourne has kind of fallen off a cliff over the last few years. It's going to rise straight back up. That's a lot of job creation that happens. There's so many other industries in Melbourne specifically. The compositional mix of the economy, Melbourne is going to benefit a lot. So the economic impact really strong. Lower mortgage balances than Sydney, but really, really high sensitivity to interest rates.
Right.
Partly because of mortgages, but also because the economy itself is very, very sensitive to interest rate changes. So
Very cool.
Melbourne going to do very well from this rate cutting cycle. We've talked about that at length. It was part of the reasoning why we've been saying Melbourne for 6 to 12 months, where it's just you got a position for this major economic change that's happening.
Yeah.
The change is here, and Melbourne's delivering the goods already as a result.
Amazing. What about Adelaide?
This is the one that surprised me. Adelaide is going to have a significantly more interest rate sensitive market. So my thought processes around Adelaide have evolved over the course of the year, where it's hey, look, affordability constraints are there, but it is super interest rate sensitive. The composition of the economy, again, very, very similar to Melbourne and Sydney, which isn't something you think at face value. You think it's a smaller economy. You think it might be a bit like Canberra. When you go there, it feels a bit like Canberra. That's my feeling all the time. Been in Adelaide a lot over the past 6 months, but very, very broadly, an economy that's super diversified will benefit from the rate cutting cycle a lot. And mortgage balances have shot up there as well. So very high sensitivity as well.
So what happens there? So affordability just becomes better, and then
it does.
So do you expect Adelaide to also relatively perform well? Because I know there were some concerns about affordability there, right? I mean, you were saying it's one of the most unaffordable cities now.
I would have said that Adelaide cannot grow any further. Materially, it's hit its cap. Sure. A little bit like Sydney, where it's just it's hit its cap for its ability to keep growing right now. Adelaide was there, but if you drop interest rates 150 basis points, then Adelaide has, I would say, a little bit more, has another 20% to go just from rate cuts, if that makes sense. So that's how I'd view it. And, if I own in Adelaide and I knew this rate cutting cycle was there, I'd be like, I'll keep it. I'll keep it for a bit longer. Yeah, you're going to be a winner from rate cutting cycles. A bit like owning a Sydney property at the moment, where it's just long term, medium term, it's going to need time to bake in all that growth that's happened. But the rate cutting cycle is going to trigger another little round of potential price rises, and Adelaide will soak that up. The housing demand supply imbalance will mean that price appreciation happens, and it'll be owner occupied as well.
Amazing. And do you see sort of some a similar story play out for Brisbane as well? What's their
similar
composition like?
Similar. I think Brisbane is the market with the strongest long-term economic change fundamentals, though, of all the markets that are looking at this point in time.
Even better than Darwin.
Yes.
Oh, wow. Okay, that's surprising to me.
Long-term. Really long term.
I was joking, by the way.
Oh, really?
Yeah,
okay,
yeah,
cool. I couldn't tell.
Yeah.
I'm like, Darwin, I'm not sure. It's just too much is up in the air with regulatory approvals, and it could be, it's so small that
too dominant as well in a single sector.
Darwin's wrong to think of it as a capital city. You're almost talking about a suburb in Brisbane, or like a different region.
The amount of hate that is coming your way.
That's okay. Darwinites love me.
The 9 people in Darwin are going to turn up.
Did you say the 9 people?
That's right. They're coming. They're coming to Sydney.
10,000 people have heard you absolutely poo on Dandenong, by the way. And I went to Dandenong, and I went to Dandenong after this episode podcast, and I'm like, Adi, come on, man!
How could you say this about
mean?
them?
Yeah. By the way, I think
sorry to all the suburbanites in Darwin. So apologies.
So
big suburb.
Well, where was that? Darwin, Brisbane. Going to do pretty well again. Rate cutting cycle, very very similar to the Adelaide story. Very sensitive. Rate cutting just means boom everywhere. It's going to be nationally there. It's just the growth rates are changing. And when I say boom in a place like Adelaide, that's the wrong context to use, because its growth rate's going to half. So, it's going to more than half. That's right. So it's just like, no, that was a boom. This is like not a boom, but you're going to grow like because of this. So that's the Brisbane and Adelaide story.
Yeah, I think what I love about this sort of composition, right, when we sort of look at a capital city to capital city, Melbourne did not get the benefit of the last 4 years of growth cycles, right? So Adelaide, Brisbane, and Perth, they went through this dramatic growth cycle. Some suburbs grew by like 100% in like 2-3 years. How do I know? I was the benefactor of one of these suburbs, right? So they saw this incredible rise while the interest rates were rising as well. Now, Melbourne didn't see any of this. So affordability in Melbourne didn't really change at a fundamental level. Now that interest rates are starting to come down, we can see the flow-on impact on Melbourne, because it has like this huge gap to fill anyway, and it's seeing this huge benefit of interest rates coming down. So your affordability is increasing here. It hasn't seen any growth for like 3-4 years. So it has this 2 combo thing playing in its favor. So I kind of see Melbourne and Sydney as well seeing the biggest benefactor out of this. So it kind of makes sense at a suburb level, at a property level, because 100%. I'm seeing it sort of on the ground. And then Adelaide and Brisbane and the next one, Perth, I see it. Of course, they're going to keep rising, just not to the same level, because they've already done a lot of their rising in the last 3 or 4 years, right?
100%. So, that sums it up. Like that affordability constraint, it's going to be the main constraint on growth as a macro sort of concept.
Yeah.
We've done an episode with Kurt with charts and a couple YouTube videos about this. This is naturally a constraint at the moment. Correct. For now. That will change over time. But Melbourne has affordability problems, of course, like the rest of Australia. But it has more potential to rise as well. And then there's the framework of all the investors don't have a choice anymore. Be like Perth, that's kind of there, but going away. Hobart was there, kind of. It's got rapid rental growth at the moment. But that choice framework is like, it's less attractive when you have a range of options. Melbourne, Sydney, always a little bit of a prize for lots of people there. And when you compare it all, being like, cool, these two are too expensive, so let's go to Adelaide, Brisbane, Perth, etc. All these options. There's lack of alternatives, which is exactly the same Darwin theory as what we're talking about, which I think drives more and more attention to Melbourne. And I also think, importantly, it drives attention to Melbourne satellite cities, because a lot of people have the 5% yield component or 4.5% yield plus component, and that's going to drive a lot of that spillover Melbourne demand to be really, really strong.
Yeah, that makes sense. Did you want to touch any more on Perth? Was there anything more that you wanted to sort of mention about Perth?
No, a little bit less sensitive to the interest rate story. That one, I don't think it's the biggest winner. It's not so cyclical with the interest rate story. It's almost counter-cyclical, actually. Like history tells you that when Sydney does really well, it's not the time that Perth shines. It's usually the opposite. They go in opposite directions in terms of where they sit in housing cycles. Perth, I've talked about it at length. I think it'll do more than fine. It's just there's probably better alternatives now at this price point for Perth. But at the same time, Perth does have a little bit more capacity to rise than Adelaide and Brisbane, because its yield profile is a bit higher. So
a little bit better.
Yeah. It's more, if you have owner-occupied debt, it might be time to take the money off the table when people are paying ridiculous prices and the strength is there. And to be honest, Perth has just stopped rising for a year, for 6 to 9 months. It was going at 20%, then just stopped.
Yeah, it's always going to happen, right? Yeah. Nothing goes up by 20% year on year. It's just not a thing.
The rate at which the price stabilization has happened surprised me a little bit. Usually it goes more like this rather than
straight off a cliff.
Kind of, yeah. It's like falling off a building and then just landing on the floor.
Yeah.
Like, that's kind of it. Not falling through the floor and then into the ground, but just falling on the floor and then, just going sideways. Like that's a little bit surprising. It actually doesn't typically work like that, but Perth beats to its own drums a little bit, and that's the way that the Perth sort of cycle works.
Amazing. And you did mention this, so Hobart. Can you tell us a little bit more about Hobart?
I think we need to do a couple more episodes on Hobart soon because I am starting. I've said it a few times. It's becoming the sleeper area one to watch. Probably won't say Hobart. I mean Tasmania in general.
Yeah, for sure.
So I'd say Launceston and Hobart both in this equation. Time to do more research into it and get really specific on it. So perhaps something we'll touch on a different podcast episode because it is starting to show some interest.
Science,
we picked the science up a while ago, and now that momentum is starting to kick in. So now it's like, let's pay some attention to it, particularly because Hobart and Tasmania is going to be in the rental market first before it goes into the housing market. And the rental market's showing all the signs you want to see. So it is one to be like, hey, maybe I'll put my eggs there to begin with, understanding that it's probably a 2026 story, but, positioning yourself pretty well for it. The yield isn't really as high as I'd like it to be for an area to invest in. Typically, its past history suggests a higher yield profile. But nonetheless, it's got some really positive factors attached to it. I don't think this interest rate story is really that attached to the Hobart rise, though. I think it's before that. I don't think that's why Hobart is going pretty strong at the moment. It's different reasons.
And I think a bit of nugget of wisdom for anyone watching this is when rents rise that dramatically somewhere, at some point, the person who's renting, they're like, why am I renting this? It's actually cheaper for me, especially if you couple that with the interest rate decline. Why am I still renting?
Yes.
Why am I paying $700 a week or $600 a week? Yes, the yield from an investor perspective is not great, but then Hobart had a rapid rise 3 or 4 years ago. So there was a bit of yield compression. So rents actually haven't caught up as much, which is probably why the yields are not as attractive at the moment, but rent is rising. It's sort of similar to a lot of the Melbourne markets. The rents are rising dramatically in a lot of them, all double-digit growths. So at some point, a renter is going to be like, why am I doing this? Why am I paying $600, $700 every week when I can just go and buy, use a 5%, some kind of scheme to get into the market?
For sure.
So when that tipping point happens, that's when the owner-occupier demand starts to increase, because you suddenly have a completely new pool of entrants into the housing market who were originally renters but now can become owner-occupiers. That's the little inflection point. We have seen that in a lot of the Melbourne markets as well, as rents sort of went through the roof when there was a bit of an exodus of investors, land tax. So we see a lot of these things play out. So I'm in the same camp as you, man. I think Hobart is one to watch. Whether it's a 2025 story, I don't know. I think it's more of a 2026, 2027 even story. But it is exciting though.
I think it's going to be my gut feel. It's too early to say this, so maybe I shouldn't even say it. But my early indications is I think I'm going to be talking about Hobart as like the next market to watch at a point in time. I think we'll be talking about that when you drill down into the economic reasons as to what's going on there. I think Hobart might be the one where it's like, but it's just still a little bit too early because its value framework is one where it's like, I'm a little bit unsure on its value framework because of its current price point. But yeah, it's got a lot going for it as well. So very, very interesting story to look at Hobart. And if I'm a property investor, I'd buying
definitely consider it
pieces. I'd be considering Hobart and Tasmania.
And again, depends on where you are in your portfolio, right? I mean, it doesn't always have to be a Melbourne story. If you're sort of buying your fifth one,
you've got 4 in Melbourne, then
maybe it's time to go to Hobart. Yeah,
it's pretty cool.
Very cool.
Adi, thank you so much for this. This was really insightful as
well.
Learned a lot. Going through the different markets. And if anyone's got any feedback on episodes like this, drop it in the comments below and we'll be doing more and more of these for you and going through the markets and different reasons why the markets are doing well.